thanks everybody for joining us here. Got a wonderful panel to talk about the dollar and its impacts on people's investments. I think it's quite honestly, especially here in the US, something that most folks just kind of take for granted and they don't even think about it. And well, that's a huge mistake, regardless of your belief. I brought a prop, by the way. Okay. In God we trust. Okay. So thank you, Dan Petersen. Thank you, Julia Hermann, and thank you, Fritz Folts, for being here today in Think Tank Exchange. Maybe we'll start with Julia and give your background, Julia, and then we'll go to Dan and give your background. And Dan, definitely do mention any of your thoughts on Index IQ and New York Life, and then we'll hear Fritz's background, and then we'll get right into the discussion.
Absolutely. Thank you so much for having me today, Dan. My name is Julia Hermann. I am a multi-asset portfolio strategist on the multi-asset solutions team at New York Life Investments. We're focused on multi-asset investing across the world, true to our name. My background is in the emerging markets. I spent 5 years as an emerging markets investor, leading global strategy in that space. So very excited to be here talking about all things dollar. It's obviously top of mind in the news cycle and top of mind for investors. So glad to be here.
Dan Petersen, thanks Dan for having me on. So I've been in the asset management industry since 2003 with Index IQ since 2012. New York Life acquired Index IQ back in 2015. So I've been with Index IQ in some capacity for the past just over 10 years. And Index IQ started with one of the first alternative ETFs over 10 years ago, and now seeks to take the best attributes of both passive and active investing, making strategies available in low-cost, liquid, and transparent products. While New York Life Investments, which Index IQ is a part of, is a diversified global asset management firm with over 600 billion in assets under management, and investing in our clients' successes with guidance, resources, and investment solutions that reflect the diverse perspectives of the various boutiques within the firm. Currently, my role as product manager is developing content around all the ETF solutions.
Fritz?
Thank you. Thanks for having me. I'm Fritz Folts. I'm the Chief Investment Strategist at Hedge Asset Management. I also sit on the investment committee and a co-founder of this firm. Hedge is a multi-asset tactical investment management firm. We invest across asset classes. We invest across geographies. We create portfolios really exclusively through index ETFs. And the core of our team, we've been doing this really for 20 years. We started at our prior firm, which was Windward Investment Management back in the early 2000. And I think we're sort of pioneers in this space at that point. All of our research is driven by our proprietary model of the global capital markets. So we're looking at valuations, economic and market fundamentals, as well as investor behavior. And we, as I said, we invest at the index level using ETFs. Our portfolios are dynamic in that we're making changes when our outlook changes, and they always are globally diversified. So that's a little bit about our firm.
Oh, by the way, and thank you, Fritz, but for those who don't know me, I'm Dan Weiskopf, the ETF professor and also lead ETF strategist for the ETF think tank and portfolio manager at Tidal. So I feel very passionate about the issues around the dollar because candidly, I think it's something that here in the US, most folks just take it for granted. And, the direction isn't, having an impact. But then there are some folks who are pounding away on the opposite extreme and they're thinking it's going to collapse. And then other folks, it's like all over the place. And yet let's just go over a couple, just key factors that are driving it. And then we'll let Julia take it away with her thoughts around the dollar, and then we'll drill into some questions. Listen, we all know it's a reserve currency. We know it's impacted by inflation, political stability, direction of interest rates, but of course it's direction of interest rates across different countries, and everybody's got a different agenda. So of course speculators also have an impact on it. Oh, by the way, trade deficit and public debt, right? Because as an example, the US government is a big borrower. How all these things work through and drive the dollar, for me, seems to be very perplexing. But Julia, of course, has a strong opinion about all those important factors, and I'm going to let her take it away and explain her views.
All right, Dan. So let's talk first about kind of the base of things, which is what you mentioned, reserve currency status. There are, of course, a million different factors that can affect the level of the dollar and exchange rates over every time horizon. But currently, the base of the global financial system is the dollar, and it's that way for a reason. So let's talk about that, because there's a huge de-dollarization narrative that's happening. It's probably why we're talking about the dollar today. And it's no surprise that that narrative is resonating amongst those that would benefit from diversification away from the dollar, from the cryptocurrency space to other countries that haven't benefited from dollar dominance. But ultimately, there's some geopolitical events that have been happening. China brokered a deal between Iran and Saudi Arabia. You have Brazil and Argentina talking about a currency union. There are some geopolitical events that have really been spurring this narrative. But if you boil it down to why the dollar is the world's reserve currency, I feel very confident saying that I don't think it's going anywhere for the next several decades. And that's because it takes a ton of requirements to be a reserve currency. The first is that a currency must hold its value independently. What that means is that a currency must be free floating. There must be global trust in a central bank, and you can't be relying on currency manipulation or capital controls to maintain the value of that currency. Otherwise, people won't hold it as reserve, they won't use it for transactions, they won't trust it. A reserve status currency also must be fully liquid, it must be globally transactable, fully convertible, and globally accepted. So there are a few metrics that we can use to measure just how dominant the dollar is. A lot of people like to cite the fact that it's 59% of global reserves in terms of what global central banks are using in reserve. People like to talk about how that ratio has gone down over the past several years, but frankly, it's still incredibly dominant. But let's consider a few of the other factors really quickly. The first, liquidity. In my view, a great measure of liquidity is a bond market that a currency has behind it. And for the US, foreigners comprise about 35% of what's happening in the US Treasury market. So a huge amount of liquidity, a huge amount of foreign interest. The dollar is also broadly accepted, not just in that every commodity is denominated in dollars, but also in the fact that when other countries issue debt in a currency other than their own currency, in the dollar, for instance, there's risks that they're taking. And the only currency that they really take those risks on is the dollar. So lots of countries out there issuing in the dollar when they can't otherwise attract flows in their local currency. The dollar dominates 64% of that market. It's also about 45% of global transactions. So the extent to which the dollar is truly embedded as the anchor of the global financial system is truly not to be disputed. And if you think about this framework, which I know we're going to do at various points throughout today, we can talk about whether other currencies, from the renminbi to the euro, whether those pose a credible competition to the dollar in the decades to come.
Yeah, it's interesting. I was listening to another podcast, and it's something that here in the US we kind of take for granted that I can transfer money very easily. But like, as an example, that's just not the case in various other countries. Even as an example, Canada can't buy yen. They've got to buy, and you tell me if I'm wrong on this, they have to buy the dollar and then buy the yen.
Yeah, so because the dollar dominates the predominant global payment system, which is called SWIFT, usually the dollar does tend to be the go-between when it comes to transactions, whether that's just proper Forex or that's actual trade. So yes, the dollar is the go-between for a lot of different pairs of currency. But also, actually, I'm really glad that you mentioned that, because even though I'm very convinced the dollar is sticking around for a long time, I don't want to invalidate the kind of movement toward de-dollarization that we're seeing, because in principle, if not because of how global payments actually work, if I am a Brazilian soy farmer and my client is a Chinese, cattle producer, why would I in principle have to transact in dollars? I very much understand that, it's valid, but at least in our view, there's a lot of room for certain portions of transactability to diversify from the dollar without it being an existential threat to dollar dominance.
So Dan Petersen, speak to us a little bit about how that might affect volatility in somebody's portfolio, and your thoughts around that.
Definitely. So I think most people who invest internationally, US-based investors that invest internationally, don't really think about currency. A lot of currency conversations probably come in front of those people who either want to trade Forex, independently of equity investing, or those that want to make a decision between how they want to be exposed internationally to equities, right? We can look at things like international index returns, which are always going to be, or not always, but if they're based in US dollars, which is what you typically see on CNBC and other areas, you're going to see the US dollar index, and that's going to reflect changes in currency strength. So if the US dollar strengthens versus developed markets, right, a developed market international index is going to suffer from that because the foreign currency goes down in strength, and therefore that takes away from the local equity returns. So when I say local equity returns, what I mean is if you're investing in a British company in that area, right? I'm not dealing with currencies whatsoever, right? If the British company goes up 5%, I have a 5% return. If you're a US-based investor and you're investing in a British company through an ETF or other type of fund, you're converting your US dollars to the pound, investing in that company, you get the 5% return. If the pound devalues by 3%, you just netted a 2% return. And those numbers are not far off, right? You can have currency movements within a year of 10%, no problem. And in fact, last year we saw currency movements beyond 10%. I wrote an insights piece we might talk about in a little bit, where those were into the double digits, well into the double digits for a while, in terms of currency movements. So most people, they invest in an international strategy. They don't even think about currency. That's just kind of part of the deal. But as more and more types of ETFs and different types of exposures proliferate in the industry, you now have a decision that you can make, and therefore it's meaningful. I can decide to take currency exposure with that investment, or I can decide to not take currency as part of the returns using a hedge strategy. So there are different ways to play it and think about it now that those exposures are available. So the proliferation of different types of ETFs has definitely involved itself in international investing, and now poses that decision for many people to think about as a way to either avoid, to your point, volatility, because currencies go up and come down, and that creates volatility. If there's not a net return, right? If currencies go up and then come back down to where they were, you just added volatility to your investment without any return, right? So that's kind of, everybody thinks about what's my return per unit of risk, right? How much am I making for the risk that I'm taking? What if I'm not getting a return for the risk that I'm taking? Now I'm just adding risk. And when you look at returns domestically, right, with let's say an S&P 500 index versus internationally, domestic equities have done really well over the past 20 plus years compared to international investing. So you start to now weigh in the decision of if it's even worth it to invest internationally. But a lot of people don't realize that decision is being impacted by currency movement. So looking at international returns and saying, this doesn't really help me because I did so much better domestically. If you take currency out of that equation, that actually changes the story quite a bit, especially last year.
So Fritz, as a portfolio manager, what are your views on the dollar, and how have you in the past traded on those views, and what are your views on the future?
Great. Yeah. So we're global and tactical investors. And so we're investing across asset classes. So in terms of equities, for example, we're looking, our investment universe includes the US, Europe, Asia, Far East, and the emerging markets. So we're very much global in that aspect. And our model research, it is all based on our proprietary model. And our model research incorporates the impact of currency on potential investments in ex-US markets. So we look at the equities in local terms, if you will, but we also consider in the model the potential impact on the risk-adjusted returns that are projected by the model of currency. And so that's incorporated in each of the different equity asset classes that we look at. We also happen to run just a separate currency model where we're trying to understand on a relative basis among the major currencies, which are the most attractive to the least attractive. And that we use more as just a way to inform the investment committee. So if we're making an investment decision and the model is giving us certain output and telling us we might consider doing one thing or the other, it's good to see, well, okay, fine, but let's think about what the model is also telling us about the potential for, the currencies there. So that's the way we do it. We're global in nature. We have to and always have thought about currency and currency risk and currency exposure. And our model, we've been doing this for a long time, and the model has learned how to incorporate taking currency into account when it evaluates the ex-US markets. So that's how, it's very much a part of what we do. It always has been, because we've always been global investors.
And what does your model take into account as a trigger to switch between?
Right. Yeah. So we spend a lot of time domestically, in general, looking at interest rates, and we're looking at yield curve, shape of the yield curve, the change in the slope of the yield curve, that rate of change, because we know there's a lot of information embedded there, and it's market information. It's not derived, and so we feel like we can trust it. One thing that's important to us when you're looking at currencies, for us, one of the things we look at is relative real long-term yields. So one thing that we look at is you take a country's 10-year sovereign bond versus the rate of inflation in that country. And so you're looking for, are you seeing real rates rising? Because that could make a country more attractive to the relative to the other countries. So we're looking at things like that and incorporating that into our analysis.
Okay. I get it. And Dan, when you, I'm going to pull up your I call it a white paper in a minute. Speak a little bit about your findings in that, from that paper, if you would.
It just so it basically highlights the differences of investing with a hedge to currency and without a hedge to currency, or looking at the local equity returns, right? So again, if I were to be able to be in all of these different locations internationally and invest in those companies that make up an international index and not having the impact of currency, what do my returns look like? Of course, that would be difficult to do. How most strategies would implement that type of exposure would be to put a hedge in place where it would have an exposure against the currency movement, right? So I know that inherently I change my US dollars to, let's say, the British pound to invest in British companies for that part of the exposure. I then have a hedge contract in place to be able to revert the movements of the currency. So if the pound goes down, my hedge contract profits to that same amount. So now I'm isolating the equity return. If the equity in that region is up 5%, I get my 5% because the hedge offset the currency movement. And that's great if you have a view that currencies are by and large going to weaken versus the US dollar, right? Because that would take away from your international equity returns as a US investor. If you have an outlook that the foreign currencies are going to strengthen and the US dollar is generally going to weaken, you would want the exposure to the foreign currency. Most that we speak to, at least, seem to not really have a strong view in either direction, because it's also difficult to have a view on let's say 13 different currencies. If you look at a broad developed markets exposure, it's hard to have a view on all of those. Although, the US dollar does seem to be a bit centric in terms of its movement. One of the findings in the insight is that the yen tends to move differently than the other developed market currencies. If you look at, let's say, the broad index of developed markets, that tends to have a slight positive correlation to equity movement. So when equities are up, generally those foreign currencies strengthen a little bit. And when I say a positive correlation, it's like 0.1. It's not strong whatsoever. But the euro has a little bit of a stronger correlation. So when those developed markets are up, generally the euro is up a little more so in line with what's going on with the equities, and that's closer to a 0.18, 0.2 correlation. The yen is actually negatively correlated pretty strongly, over 0.2 negative correlation to equity movement of international equities. So if I have a positive outlook on international equities, which would be a reason to invest internationally, of course, I would maybe think that the yen could drag back that performance a little bit. And that's why, if you look back to 2015, when Abenomics was an issue that was happening at the time, because they were intentionally devaluing the yen in order to spur exports, the hedge trade made a lot of sense, right? Because you knew that that was the intention of Japan, was to devalue the currency. Therefore, I would not want to have exposure to that currency. And they're doing it intentionally to promote exports and have growth. So I would want equity exposure there. And that was a very popular trade at the time. If you look at flows into hedged Japanese ETFs and strategies, though, it tended to be a little bit late, right? It's a little late in that theme that was happening. And that's one of the biggest problems we see with trying to time currency movements between hedged and unhedged exposures, is we see a lot of flows happen into unhedged after unhedged has outperformed, because most people like to look back and say, this is a strategy that has worked relative to the other side, right? So if hedged has worked relative to unhedged, I should go hedged. And it's human behavior, right? I want to choose the one that's been doing better. But generally, prices don't just keep going up in one country versus another country. They kind of go up, they kind of come down. You can look at over short terms, over mid terms, and long terms. There's volatility no matter what period you want to look at. Day to day, we see volatility recently. With that said, it's very, very difficult to time that currency exposure, and it's not something that most people would have a long-term outlook of return, right? It's more of a kind of a temporary phenomenon of strengthness and weakness. And for those that implement a view, it can supplement returns decently. But if caught on the wrong side, it can annihilate returns, right? If we look at 2022, last year as an example, the downside, the local equity return was more than doubled because of the currency exposure. So if you were able to invest in those local equities without the currency exposure, you would have half of the downside as if you were to assume the currency exposure. So it was that significant in 1 year alone. 2021 was almost the opposite story, where currency returns supplemented equity returns, and you were very happy to have foreign currency exposure, in that particular calendar year. So we can look at it at calendar years, we can look at it in trailing basis of months, years, even decades.
Yeah. So the point, which I find staggering, is that if you have similar indexes, but you have, we'll say, 50% exposure either direction on the dollar, right? You have a lower risk profile.
Right. So that's what the ultimate conclusion of the insight is that have a view. If you want to implement the view, there are ways to do it. You can go unhedged, you can go hedged. If you don't have a view, one of the most efficient ways to implement that exposure would be to hedge half of the currency risk. And by doing that, you are able to participate when currencies are strengthening internationally, not as much as unhedged, of course, but you're able to avoid some of that downside, which, as I mentioned last year and in other years, not too long ago, really took a toll on equity performance. So what you're doing here is you're kind of managing that exposure and risk. So you're lowering your risk because you're lowering your exposure to the currency movement, but you're also not giving up all the potential returns that can happen when foreign currencies strengthen. So the bottom line is, most people, especially when they look at ETFs, they think passive, and they think, I'm going to just look at market cap weighting, or I'm looking at some type of smart beta product that has a rule set and methodology. Active ETFs are proliferating more and more recently, but I think the common assumption still is that ETFs equal passive for the most part when you look at 2,500 or so ETFs that are available in the market now. And people think index exposure, but a lot of times people don't think that next thought to think that international indices do reflect US dollar movement. So is there a way to more passively invest internationally than what has been commonly held for a long time? And I think the answer is yes. If you were to look at hedging half of the currency risk out, you're not taking a view going forward of foreign currency strength or weakness, understanding that over time it's going to rise and fall and probably be mostly a net zero return with risk. So an interesting way to passively approach that, and not knowing where we are currently in the cycle, right? Is it going to continue to strengthen again? Year to date, it's actually strengthened internationally, yet we're starting to see potential market weakness again, which would mean because of that positive correlation, market weakness could go back to dollar strengthening again. So it's a very difficult environment to navigate, and if you don't want to have a view and pick a side, that 50% approach could be a way to passively do that.
So I'm definitely going to come back to you, Julia, on that exact subject, but I want to tilt to Fritz and ask him a question. Do you find that a lot of financial advisors, because that's who your clients are, ask you about the dollar on a regular basis, or is this something that candidly people just don't talk about?
Well, my short answer to that would be not usually. No, I would say that advisors in general are very US centric, and even don't think that often about investing in ex-US equities. Now, that's an oversimplification, but a larger sample size would tell me that, the focus is, and, I guess that makes sense, right? Because so for the past so many years, you put your money in the S&P and go to sleep and wake up. Well, I guess except for 2022, but the US market has been on such a tear and done so much better than international markets. So I think that's part of it. People just sort of drifted out of their consciousness, and it will come back, once the ex-US markets start to do better. But in general terms, no, they don't really think about it. And in some respects, they rely on us to think about it. But I would say it's not front of mind for financial investors. They're definitely more US centric, which is, yeah, absolutely.
So Julia, you've covered a lot of the trends around the dollar. Which do you think right now are leading to the direction of the dollar right now? Is it interest rates? Is it the deficit? Where do you see the emphasis these days?
Yeah. So I mean, first of all, I feel like I just want to go back to what Fritz was saying, which is so interesting. The idea that kind of in his world, he's getting less questions about the dollar. A lot of our clients and a lot of the folks that we work with are also sort of US centric investors. Pretty much every American investor probably is. But actually, we've been getting a ton of questions about the dollar. And I think it's because they're US centric, because they're worried of, oh my goodness, does this change my investment landscape if the dollar is no longer as dominant as it once was? So really interesting to see both sides of the coin there. If we think about, the trends that are supporting or not supporting the dollar, recently they have not been supporting the dollar. It's really, really interesting to think about fundamentals versus a lot of the expectations right now. One framework that I like to use to think about the direction of the dollar is called the dollar smile, which basically posits that the dollar is going to be stronger when liquidity is draining out of the global system. It's going to be stronger typically when the US is outperforming other countries, or when the world is in a global recession and the US is perceived to be a form of safety. And under this framework, the forces that would weigh on the dollar would be when every country in the world is doing better in terms of growth, liquidity is plentiful in the system, and folks don't feel like they need to seek the relative perceived safety of the US. What's really interesting is if you look at the fundamentals right now, it feels like we're on this steady, slow march toward recession globally. Liquidity has absolutely drained out of the system in a dramatic way. But it's done so off of a really strong base. And in the past few weeks and months, we've actually seen more of a narrative of the fact that financial conditions had been loosening. When the banking crisis that wasn't happened, there was some liquidity support provided there to the tune of about $300 billion. So we've seen a temporary softening in some of those liquidity expectations. And I think that's been a big part of why the dollar has been seeing some pressure. But, when it comes to the expectations, they can shift back just as easily. For example, I think something that's been really supportive of the euro area is the fact that everyone was basically expecting an energy crisis when we went into this winter. Fortunately, it was more mild than expected. So prospects for European growth have improved pretty dramatically since then. So lots of expectation shifting at the margin. But if we think about where we're going to be in the next 6 months, 12 months, ultimately, we are looking at a potentially global recession. The US is certainly seems like it's on the path toward recession. And we are looking at liquidity continuing to drain from the system in that pretty dramatic fashion. So my bet would be that this leg of dollar weakness might be temporary or might stabilize.
If I could bring both of those thoughts into outlook internationally, I've definitely seen the same thing as Fritz in terms of there being a tremendous overweight domestic versus international amongst various investors that we speak to and advisors. And if you look at in isolation, of course, 2022 was one of the most challenging years with equity returns out there. It did make a very, very small case for international investing. If you look at two common international indices out there are the Vanguard FTSE FTSE index and the MSCI EAFE index, EAFE, which include developed markets exposures. And if you look at those returns versus the S&P 500, you're looking at about 3% or so of an advantage. So the S&P was down a little over 18%. These international indices were down in the mid 15% area. So is it a great diversifier? I don't know. If I take currency out of the equation though, and I look at a hedged version of those indices, I was only down 5%, 1,300 basis points or 13% annual difference in the return between international and domestic. So that's again where the currency actually was a major part of the contribution to returns for those international exposures. If you were, on top of your game and you knew currencies were going to go, where they went in 2022, and you knew that it was going to be a very challenging equity environment, that profit could have been made with the right outlook. But that's a very tactical, betting type of exposure, right? So we can look at this in many different ways. But another outlook in terms of, that's what happened in the past, what can happen in the future. What people tend to look at when it comes to international versus domestic equity exposures, one of the things you can look at is valuations, right? I can look at things like price earnings multiples, and are these companies expensive relative to what they earn as a company? And traditionally, U.S. or domestic equities are just always at a higher multiple than international equities. It's just kind of a natural occurrence. I don't think going back to 2003, I think I did the research, there was ever a time going back that far that international price earnings multiples were higher than U.S. earnings multiples. But what I can look at is the range, right? What's the range been between the discount of the international equities versus the domestic equities? If I look at something like the S&P 500 index versus any one of those international indices, and that discount in valuation has changed over time. And if you look at the points where that discount was at its widest point, where international equities were much more attractively priced when looking at it versus their earnings, you had a much better advantage to be invested internationally. And currently, if you were to look at that range going back to 2003, we're at the bottom 10% in terms of that discount, meaning that discount is so wide that it's only been 10% of the time since 2003 that we've seen such a discount internationally versus domestic. Does that mean that they can't both go down? No, it doesn't mean that at all. It just means that that gap could close, right? And you could have an advantage to be invested internationally versus domestic if that valuation gap, starts to close again. So again, it's just another interesting observation that it could be advantageous to diversify with international equities if international equity pricing starts to come back in line with historical norms versus the U.S. It could be that the U.S. price earnings multiples just decline back to where the international valuations are, but it's just an interesting observation that domestic has outperformed international for so long, you know, we might see that rubber band start to snap back a little bit.
Coming back to my dollar, jokingly, I bring that up because here we are, in God we trust, right? And there's a debate about, and I joking about this, but there's a debate about whether they're going to raise the debt ceiling. Should we just get rid of this debate and just eliminate that as a subject matter? I mean, to me, it's kind of laughable, because if they don't raise it, what happens, right, to the dollar? Anybody care to, like, jump ball here on that question?
Fritz, do you want to start?
Come on, Fritz, let's have some fun here.
I
I can
mean,
start.
you know, it's just crazy that the situation that we're in. And in fact, we've now even taken our cash or cash equivalents or short-term treasury positions and extended them out beyond the period of time where you would hold ETFs that they have, where they're going to have to roll those treasury bills in, you know, conceivably in this period where something really bad is happening. I mean, that to me just seems insane that we even have to do that, but we did it. We're doing it. So I don't know what happens. You know, we've come to the edge so many times. But we took those steps because we're uncertain enough that we don't really want to be, you know, playing around if something really bad happens. So I guess it's not much of a prediction, but we took it seriously enough that we adjusted even the cash equivalents in the portfolio to get us over, or hopefully over, that period of time, more into the September timeframe, where hopefully they'll figure this thing out.
I'm of the view that if the US were to default, if the debt ceiling wasn't raised, and if a whole bunch of other emergency measures, which the Treasury does have available at its disposal, if those were to all fail, in the incredibly unlikely scenario that the US defaulted, that all of us investors talking about our allocations would probably be the least of our worries, because frankly, I don't think it would matter, right? Treasuries are the risk-free rate that is the basis of the entire financial system. Frankly, it is unimaginable to even start thinking about the impacts of a default. I've gotten questions probably every day for the past few weeks. Someone says, you know, what if a default happens? You know, should I be worried about this asset class? And I was like, you should be worried about a lot more than that if the US defaults. So I'm of the view that, you know, Fritz, I totally agree with you. We've come to the edge so many times, and that brinkmanship helps no one. It does generate volatility. And a particular concern that I have about this round of things, not just the fact that we have an ungodly amount of debt that came out of the pandemic that we need to grapple with, not just the fact that our debt financing costs have risen astronomically as the result of the Fed hiking cycle, not just that, but the fact that we've seen $300 billion pour into the money market in the past month, right? So everyone seems to be trying to get protection at any cost. The 1 month yield has plummeted. We've all seen that in the past few days. So you have folks really trying to find some security, some relative risk-free investments that are also delivering that yield. But that's the exact same portion of the curve that's likely to get hit with all this volatility during this brinkmanship that Fritz mentioned. So I'm concerned about the volatility. I'm not concerned about a default, because frankly, my imagination just doesn't go that far.
Yeah, and I think, you know, I think the defaults is like less of the question. I think it's more of just this political game for the two sides to get what they want and into the bill to pass the budget, right? And I think at this point, I mean, with financing costs going up so high, it's come to a point where I think the government needs to figure out some type of long-term plan to stick to in terms of, you know, the incremental, you know, raises in the debt ceiling. Because at some point this all has to break, right? And at some point, if there is another country out there that's a little bit more coherent with how they manage debt, that might start to play into a long-term risk, you know, in terms of you know, the currency strength. I would think, you know, it's got to be removed from this political game and be more of a long-term plan. I would, you know, I think we're at that point now.
And, not to belabor this subject, although, it's very timely, it's in the news, I think people do want to discuss it. What we did during the pandemic is we monetized our debt. We printed money to pay our bills. And it is a economic technique as old as time, which generates inflation. And that's why we are where we are, right? The idea that you have to think about fiscal austerity after that happens is also part of the playbook, right? Britain ran into this during its gilt crisis several months ago. How many months ago? I don't even know how many months ago that was. What is time? Last year. So Britain has already run into this idea of, okay, we just can't keep spending at the rate that we were, and certain spending plans are not going to be seen as credible anymore. I think the real question that particularly pertains to this raising of the debt ceiling is how far the US's exorbitant privilege is going to get us. Every other country would have to enter into some sort of fiscal austerity after spending what we did during the pandemic. But we are the US. We get to rely on the fact that the world wants dollar debt, it seems, even if it seems like we're on the brink of default. So I think it's a really big question that we might not know for the next 5 or 10 years. How far does that exorbitant privilege of having the world's reserve currency, having the dollar, get us out of the idea of having to really hunker down on the fiscal side in order to balance things back out after spending so much?
So should we be downgraded on our credit at least? I mean, should there not be some kind of penalty here for being irresponsible?
Well, I think irresponsibility is probably debatable, right? Because a lot of people, probably including myself, would argue that what we needed to spend during the pandemic was indeed necessary, right? I definitely won't go into the realm of should we get downgraded or not, but I do just probably want to bring back up what I mentioned very briefly, which is that it's not just a question of what happens in Congress. Janet Yellen wrote a letter to Congress saying, I am having to use extraordinary measures to keep us from, defaulting on our bills right now. But there's a lot of other measures that can be taken. I think during the last round of the debt ceiling debate, there was discussion about minting, a $5 trillion coin or something like that. It was probably even bigger, maybe even a $50 trillion coin.
Yeah.
There are certain emergency measures that I think can be used as a backup. Part of the reason why I'm not worried about ultimately there being a default resulting, but I am worried about the volatility.
Yeah, the volatility. And the volatility is also a function of inflation, right? Because we don't necessarily have that under control. They're good signs, that we're seeing right now, but a rebound inflation would like totally screw things up. Under the conditions that we're looking at right now, what tools do the Fed have to, manage that risk as well?
I can take a quick take on this, and then Dan, Fritz, please jump in. So when it comes to fighting inflation, the Fed has a pretty limited set of tools, actually. The Fed has to try to affect demand in the economy. They can't affect the supply of things. They can only affect demand, and they do that by making money more or less expensive, right? They also do this by controlling the balance sheet, of course, which we know has usually taken the form of QE or QT. But I think that, for example, when OPEC surprised with that supply cut, I think the reason that things like that really rattle the markets and investors and just normal consumers and folks is because the Fed can't, control oil supply, right? They can only affect demand for oil. So not everything is under the Fed's control. They have made significant progress in bringing inflation down so far, but we really do have a very sticky services sector inflation problem that is still being addressed. So I do think that energy risks are probably something we shouldn't get sanguine on, but overall, I think the focus is very much on services.
You guys don't want to, run with that further, or we can all just agree with Julia. She's the smartest one in the room.
No argument there for me. Yeah.
So in all seriousness, though, there are a lot of concerns around China. The emerging markets, frankly, are becoming increasingly more important in terms of demographics, right? What impacts do the emerging markets needs have on the US dollar as they become more important to GDP growth globally? Fritz, you want to run with that? We just want to make sure that.
So, I mean, the problem with, one of the questions that I was just at a conference, and the question I got over and over again is, well, is China investable? Is it investable based on, what's been transpiring and all the tensions that have risen so far? And I mean, my answer is, yeah, it is investable. I think that we're not necessarily thinking about this in a very intelligent way, creating more geopolitical tension probably than is necessary. We can compete with them and try to limit what they do in terms of being bad actors. We can say, that's the reality and we need to fight against that. But I think it's just not good for anyone to try to isolate the Chinese, and it just makes them, in some respects, I would say, behave more badly. And so at least that part of the, throwing them into the emerging market equation, it's counterproductive, but there are investment opportunities there. It's still investable. So that would be the one thing that I would highlight when we think about emerging markets. And they are becoming more, we spend a lot of time looking at India, which I think is about to become, if not now, already the most populous country in the world. And and they have relatively high rates of inflation constantly. They have issues, but that's a very interesting market for us. And again, the demographics there are off the charts. So the percentage of the population is under the age of 24. It's just amazing. And, to the extent that, as people say, demographics are destiny, you have to pay attention to a place like India. And we do invest in India. We aren't currently invested there now, but we have in the past, and I think we'll continue to do so. For us, the emerging markets are always in the conversation, but it takes time and effort and research to really understand, what's going on there. But, we like, long term, yeah, emerging markets, very, very attractive area. But we're also focused on risk. And so, what, we're going to let that opportunity pass us by for a while until we feel that the risk reward is in our favor a little bit more. So that's why sometimes we're on again and off again when we look at the emerging markets.
Yeah, Fritz, I couldn't agree with you more there. China is absolutely investable depending on how you want to do it.
Sure.
And emerging markets very much have risen in importance and also in independence. And that kind of circles us back to the currency story. The emerging markets of 10, 20 years ago were very much considered to be 100% a function of the dollar. Dollar up, emerging markets down, because emerging markets have to issue dollar debt and they have to transact in debt, and they export commodities which are dollar denominated. That story has become much more nuanced, in large part because these emerging markets have built up a lot more domestic economic stability. They are less reliant on the dollar. Frankly, they're less reliant on their US trade relationships and becoming on aggregate more dependent on their relationships with China. So that kind of all fits into this idea of, China is trying to become a more globally transacted currency. Frankly, I don't even think it's probably that much of a policy goal to achieve reserve status in the near term for China, because it's just not possible. China's currency is managed against a basket of global currencies, which include the dollar. You cannot be a global reserve currency if you don't have a free floating currency. China relies to a huge extent on capital controls to keep renminbi in the country. So a currency like that is not going for reserve status. But given China's share of producing and consuming commodities, given its share of global trade, specifically in the emerging markets world, with the likes of India, Brazil, et cetera, that goal of more transactability is valid, and it's going to be one that we see more progress toward. So yeah, China can be sometimes a more nuanced investment destination. Emerging markets as a whole can be. Emerging markets, of course, can be very cyclical, as Fritz said. But their importance is certainly rising, and that's probably a big part of why we're seeing more of this narrative about how we might see some diversification away from the dollar.
Yeah, and in terms of investing and exposure to currency strength and weakness in emerging markets, just to make, I have a couple of comments on that. When you look at developed markets and the stability of sovereign rates with developed markets and the relationship of U.S. rates to the sovereign rates internationally, right? If U.S. rates are higher than, let's say, rates over with the euro or, you know, the pound, and you're putting a hedge in place, the hedge actually can be profitable if the currencies don't go anywhere, right? So the way that the forward contracts are priced is based on the sovereign rate differences. So long as U.S. rates are higher than the international rates, you're good to go. The currencies don't go anywhere, you can actually profit off of the hedge contract without any currency movement whatsoever. The opposite is true if U.S. rates are lower, right? So if the Fed starts cutting rates back down to zero, and internationally they actually have, you know, some interest rate from a sovereign level, it could be a cost to hedge. And if currencies don't move anywhere, that hedge could actually be a cost to the strategy. Emerging markets generally have higher interest rates just because of the risk. So in that sense, hedging developed market currency risk is very, very tricky and difficult and potentially expensive. And to just build off of, you know, what we look for in an emerging markets movement, I saw in the comments there the stability of governments. I think that plays more probably into you know, returns at emerging markets more so than dollar strength at this point is one of the major considerations you probably want to have is you know, the outlook on the potential for that government to, you know, do something strange or you know, odd, you know, look at China's relationship with Russia, what's going on there and things like that.
Can I just mention
Good.
real quick, one other way that we think about hedging currency, and that is through gold and investing in gold. And, you know, most often when we talk about values of currencies, we're talking about their relative value to one another. But gold is a way that you can measure the value of all fiat currency. And, you know, so if we're running into a situation where all of a sudden all of these central banks may have to be forced to ease, or, you know, the monetary tightening, you know, that could mean that the value of all those currencies might, or the support could come down, and that would be good for gold. And it's not been surprising that gold has recently been doing well. So I just wanted to throw it out there into the universe that is another way to hedge currency exposure, or current, you know, but it's more exposure to any fiat currency. And we kind of think of it as the anti-paper money, even with your paper dollar there that you're holding. Because what doesn't, obviously, you know, you buy the gold, it doesn't do anything, it doesn't pay you dividends, doesn't pay you interest, but what changes is how much paper money it takes to buy that ounce of gold. So it's something that you can consider if you're multi-asset in terms of hedging exposure to fiat currency, just in general.
So Julia, that actually tees you up a bit in the context that I wanted to ask you about trade deficits, right? And how that drives the dollar, right? Because it's something that I think often is underappreciated. But can you walk us through a little bit about how you know, what metrics you look at in terms of trade deficits as a driver of the direction of the dollar?
Sure, certainly. So the dollar is such a globally transacted currency that when it comes to the short and medium movements of the dollar, we're mostly looking at how that's impacting the capital count, so capital financial flows, rather than trade. Trade tends to impact currencies more closely, the ones that are a little bit more closed off, a little bit more insulated, have a little bit less of a dynamic capital flow situation. Broadly, the idea of the U.S. structurally running a trade deficit would not necessarily be supportive of the dollar, but we also need to think about what's happening with the key trade partners out there, right? So if we think about China, for instance, the structural trade surplus type of country, actually what's really interesting in terms of what they're facing is over the next few decades, it's likely that some of their competitive advantage on certain traded products is going to continue to move down the value chain, just like things move down the value chain to China. That process will naturally continue. And there's a lot of discussion about China actually having to import capital from now on and having to liberalize more of its financial markets in order to achieve that. So opening up its debt markets, its equity markets to compensate for the fact that they might not have as big of a trade surplus to fall back on. This is a very long-term trend, but it's interesting to note that, you know, the US is not the only major country that is thinking in terms of structural trade deficits. Also, I think it's worth mentioning India because Fritz brought them up. India is a really interesting country where they actually have quite a big trade deficit specifically on raw commodities, oil, and the like. So a lot of that has to do with the partnership and who the US is trading with. But I would probably say that I would weigh capital account and financial flows bigger versus a trade deficit in terms of long-term impact on the dollar.
Wow, our hour has gone by very quickly, everybody. I really appreciate everybody's time, those who've been listening. Please, either use LinkedIn or email me directly if you want to speak to Julia, Dan, or Fritz. Their bios are in the chat. But before we end here, I wanted to offer Fritz the opportunity to talk about his charity. I think we always think in the ETF think tank that it's important to give back. We're all very blessed here. Fritz, will you speak about your charity, please? You're muted. You're still muted.
I had it every time except the last time. Anyway, my charity is called Harlem Lacrosse. I played lacrosse in college, and I've been an avid fan and supporter. Harlem Lacrosse was founded in 2008 by a fellow from my home, or co-founded by a fellow from my hometown here in Concord, Massachusetts. When he started as part of Teach for America at the Frederick Douglass Academy in Harlem. And he was a special ed math teacher, and he was struggling and his students were struggling. So he had this idea of, well, you know what, let's pick up something we can do out of the classroom that can help. And so he started a lacrosse team at Frederick Douglass. They planned to play in a handball court. They had used equipment, very little going on. But it was a fabulous success. It's continued to grow. They started in New York. They're now programs, and it was a middle school program. They're now programs in Boston, LA, Chicago, all across the country. They're also now programs in high schools. And I have a couple statistics here that so far, Harlem Lacrosse students have earned over $60 million in college scholarships. They have 200 students currently enrolled in college preparatory schools coming out of Harlem Lacrosse. They also started a women's program in 2013. And so now there are a lot of women's programs, and that was helped by the Princeton University women's lacrosse coach who's instrumental in starting that. But it's just been an amazing program. And, it's the idea is just to break the cycle, to allow people who are, face so many disadvantages piled on top of them that have to struggle so hard, and to give them a way to really, strive and succeed and gain confidence. And it's just been a wonderful, wonderful program. So I'm always happy to support them. And thank you for giving me the opportunity to talk about Harlem Lacrosse. You can go to their website and see what they do if you have an interest in participating. Thank you, though, for letting me mention them.
Absolutely. Thank you, everybody, those who were speakers and those who were guests. Hope you enjoyed the show. My prediction, in case anybody's wondering, I think we go nowhere, all right, in terms of the dollar. I think it trades in a range, and people talk in extremes. And I think it's important just not to get whipsawed. Just listen, just my belief. So everybody, hey, Julia, Dan, Fritz, any last minute comments?
Don't get whipsawed. Love it.
Yeah, I like it.
Thanks, guys.
Thank you. Thank you very much.
Thanks,
Thank
everybody.
you.